So good morning, ladies and gentlemen. I cannot agree more with what Tammy just said, because March is really eventful. First, we had budget, and then we had the strikes by US and Israel in Iran, and then transactions in Beijing are still going on. But actually, I just came back from Beijing, for that 2 sections, and met some people. And so it's pretty busy March, but it's also very timely to look deeper into how Hong Kong can deliver its results last year. That is the financial year ending March, and also next year. So about this year's budget, there are 2 key words: the AI plus and finance plus. It summarized the entire budget already, but I think what we can do is to look into some details. Among some details, it's very interesting. My friends were saying that this could be more social or help for this sandwich class. And then some friends said, in order to benefit from the tax concessions, they need to borrow some parents and children, to make that. But I think that is just a joke. But to be honest, this time the budget has quite some macro directions that Hong Kong should follow, especially on the backdrop of the 15th five-year plan, which starts this year. Hong Kong also has its own 5-year plan later. So, all these things are going on. Is pretty critical. Hong Kong is at a critical juncture. So what I want to begin with is the surprises that FS mentioned, even though he leaked that, earlier. It's about the magic of, Hong Kong returning to surplus. So there were some factors behind that. The bonds issue, and then after you calculate the bonds, basically, Hong Kong is back in surplus in operating account. But if not, it's still in 100 billion Hong Kong dollars deficit. It's a huge number. So, can we start off with, whether this way of issuing bonds will be more sustainable? Adrian, should I start first?
Yeah, maybe representing more from a market side, I think I'm appropriate to start off answering this question. I think from the perspective of increasing issuance, going forward in the medium range forecast in the budget, it already says that we're talking about at least 80 billion to 110 billion of additional it's net issuance per fiscal year going forward for the next 5 years. I think from this backdrop, we have already started increasing in bond issuance for a couple of years already. We have always been guided with the principle that these bond issuance is for capital expenditure, as in developing Hong Kong's long-term future. And then these will be in the format of bond issuance. There's a slight technicality with the government bond issuance being matured naturally over the course of this year, and then in the future only focusing on issuing infrastructure and green bonds. This actually is positive. We have been lobbying for this. We wanted a more simpler, clear yield curve to be built and to be built for longer tenor, as in the longer end of the curve. I think all these are positive development that the financial industry needs. But from the perspective of you ask whether it's sustainable, I think we put back the economist hat and look around the region. As a share of public debt to GDP, we will be roughly looking at, according to the budget, about 20% of GDP. That will probably be the lowest you can get in the region. The other economy that has a roughly similar GDP share as public debt share as GDP, it's 24% in Taiwan. But if you look everywhere else in region, it's like 30-ish. China, 100. Japan, US, Singapore is 170%. So I think we are only at the very nascent phase, a very sweet spot where we exactly can use this opportunity of financing through the bond market to be be able to support our long-term future. But another more detail to share with you, some market color, is actually that we have been looking at the bond issuance by Hong Kong in recent years. I see a lot of fixed income investors around the world, and in Asia, there has been a very strong interest in our high quality liquid asset bonds. You can think of it from a few perspectives. From geographically, the CNH tranches has been very popular by our southbound investors. And within the Asia, I'm in Singapore and Korea, all these places continue to see that Hong Kong bonds are rather cheap and then rather good quality. And then from the perspective of clientele, we see a lot of bank basically mopping up each tranches of issuance, because these are high quality liquid asset that can be used as collaterals. It can be good top tier safe assets to be used within your banks, your finance companies, internal review for risk, but also from the perspective of using it as collateral to go tap HKMA liquidity. You don't know when your bank actually may need a little bit of additional liquidity throughout the day or overnight, and these are some of the instruments that you can use as collateral. But why not?
This sounds quite good. Professor, would you like to comment?
I think the answer is very comprehensive. Probably I just supplement a point or two. Personally, instead of looking at government debt to GDP as a ratio, I prefer looking at government debt as a percentage of the government revenue, right? But I don't think you see a much different picture. So I did some very simple calculation. Right now, the government debt as a percentage of our revenue is about 0.9 to 1.1. Okay, and you think about when the economy goes bankrupt, like at 4% interest rate, right? If you borrow 25 times of your income, then you're bankrupt completely, right? So we are way far from that, right? And even using this index, I think if you compare it with some indices I calculated quickly, may not be completely accurate. The US will be like 3.7, Japan 6.4, EU 2.0. So I think, I think whether it's sustainable depends on long-term plan, right? If we have some strategic development project, when it comes to investment in the future, I think it makes sense to raise funding through government bonds. But I think the key is that the Northern Metropolis project is going to be successful, and then it's a collective effort by the government, by the entire business community, and if universities can play a role, and the younger generation, whom might have to think about whether jobs will be there after so many jobs are being replaced by AI. Maybe they should think about being an entrepreneur. And I think if Hong Kong collectively we can build a stronger entrepreneurial spirit and then overall, and of course with the Thai connection with Shenzhen, including its manufacturing supply chain ecosystem, if we can guarantee success, then the investment is still prudent and definitely worthwhile.
Yeah, I think we can go back to that Northern Metropolis later. Thanks for your optimism. So what about Kenny?
So I guess two speakers already talked about the size, but I want to also add some points. Of course, whether it is sustainable depends on the size of the bond issuance and also for the purpose of the bond issuance. But for the size part, I think, although I think in Hong Kong the debt to GDP ratio is still quite low compared with other major economies, we still have some buffer, but we also need to be cautious because with the linked exchange rate system, we can't pin out money like US to pay the debt. And also in Hong Kong, we do not have much natural resources to sell for buffer. And in Singapore, why their debt to GDP ratio is so high? Because the issue bond, the main purpose is to give to give their sovereign fund to do the investment, like the GIC and also the MAS. So I think we need to take a balance. I think in this situation, Hong Kong still have some rooms, but if the government want to increase the market confidence, they may consider setting an upper limit of the debt to GDP ratio in the future. But for the purpose of the bond issuance, actually some other economies issue the bonds to pay for the public spending. But in Hong Kong, it is much better because the FS and the government use it for the capital work, just like the metropolitan development we mentioned. And actually, this long-term capital investment can increase the GDP in Hong Kong. It can build up a new economy and industry in Hong Kong, like the advanced manufacturing sector and also the innovation and technology sectors. So if the GDP can go up in the future, then our debt to GDP ratio will also slow down in the future.
Right, so this bond program is going to be expanded and also have a longer tenor and whatnot. So given the geopolitics right now and also the liquidity you mentioned in the market, can Hong Kong really swallow more than it can chew, in this program? Can we have quick answers?
I think liquidity-wise, I think it's still okay. We also are looking at issuing longer bond tenor. I think that's very important because in the region, we lack these type of high-quality bonds. Two is that this is a perfect match for insurance companies. I think for the interest rates, having such a long-term instrument out there to match with their liquidity management is probably a good idea. So I think there's new customers that our bond program can explore going forward. I think that's a good idea.
I do feel that the geopolitics aside, I don't know how it's going to impact that, but I think you think about the U.S. is being expected to lower its interest rate, and our currency is pegged to USD, then I think the cost of issuing bond will be lowered. So I think once again, I think all the speakers here want to take a very prudent view that this. You cannot, keep on issuing without prudence. But then I think at this point, I think the environment is and then in the near future, the general environment is still favorable.
Right. I want to go back to your point about the Northern Metropolis. So basically, there's an elephant in the room about that $150 billion transfer from the exchange fund into this mega project and other infrastructure. So the issue is the exchange fund becoming a handy ATM for the government?
Do you want to start? You can.
Okay, maybe I start first.
You all have to speak.
I think when people talk about the 150 billion transfer, they always have a lot of concerns. So maybe I first answer two quick concerns. One is whether our link exchange rate system is still safe, and the other one is whether this transfer amount is huge. And then I will talk about whether it is well for the government to do the 150 billion transfer to the Northern Metropolis. So for the first question is for whether the link exchange rate system is safe. So actually, we in our exchange fund, the total asset is about 4.1 trillion Hong Kong dollars. And about 55%, that is $2.1 trillion, is in the back-end portfolio, which is used to defend Hong Kong dollar pairs. So as long as we don't touch the back-end portfolio, actually our linked exchange rate system remains safe. But of course, we do need to enhance the market confidence on that. For the second one, whether the size is a huge size, so we can actually look into both the stock and also the flow perspectives. From the flow perspectives, the exchange fund earned around 330 billion investment income last year. So the 150 billion transfer, actually you can view it as the government cash out half of the income to do the real economy investment or the infrastructure investment, and the remaining half income they will keep in the exchange fund to do the financial market investments. But from the stocks perspective, actually this 150 billion is talking about around 4% of the total exchange fund. And as I mentioned, if we cannot use the back-end portfolio, so if we need to move out the back-end portfolio part, it is talking about around 8% in the remaining exchange funds. So it is still a huge move. So the key question is whether it will the government to spend this money in the Northern Metropolis. But of course, the Northern Metropolis is a key infrastructure project for Hong Kong in the coming 10 to 20 years. It is not just for the economic and also the industry perspective, but also for the living purpose. So from the government statistic, first, the Northern Metropolis can provide around 250 billion GDP every year once it is fully developed. Second, it can provide 650,000 jobs. And when we talk about the job, we always want to focus on the high-value jobs. So even when we focus on the Shenzhen telepost, if they has at least around 170,000 high-value innovation and technology jobs. And the last, it will also allow 2.5 million Hong Kong people living there, so it can also improve our living standard in Hong Kong. And finally, developing the Northern Metropolis, it will also help us to bring in some revenue, because if the innovation and technology industry can be well developed in the Northern Metropolis, that means more tech companies will come to Hong Kong, and hence it will increase our profit tax. And at the same time, they will also open more jobs, so it will also increase our salary tax income. So finally, our operating revenue will also increase.
I absolutely agree with Kenny. I want to extend his argument that this is positive for Hong Kong's long-term GDP growth, tax revenues. I think all these will be positive if you especially think about if you, in the exchange fund, aside from the backing portfolio, which is used to back the LERS, we also have to think about the other part, which is the fiscal reserve, which is meant to be to support Hong Kong's growth in the future. And then we're just you kind of translate that from a type of portfolio investment in the traditional exchange fund into some sort of hard asset in this upcoming injection of 150 billion into capex into Hong Kong. So I think that if you think of it that way, it's not as bad or as shocking as it is. Although as rare as it is, I think this is not the first time that Hong Kong government has been consolidating extra funds. In this budget, the bond fund and other funds has been done. This has also been done in previous budgets. But also, you also have to think about the link exchange rate exchange fund. It's a very sizable move. But then it is fine because our Hong Kong link exchange rate system is working very well. You can take 2025 May episode where it's exactly the textbook case that you want to explain the Hong Kong dollar peg, where it touches both the strong and weak side of the band within a very short duration, where the interest rate is the automatic stabilizer. Then you really don't have to be overly concerned that this could potentially be a risk for the Hong Kong dollar currency peg per se.
Yes, Hong Kong earned so much last year from the exchange fund, so that it's okay to do something. But the thing is, it's controversial. Do you think what sort of guidelines or arrangements that the government should put to make available, just to make things clear on the table, that, what sort of conditions they can withdraw, even transfer funds and whatnot?
For this time, of course, they have specified this as a one-off two-tranche transfer, because we had that windfall. But then for future funds, within the fiscal reserve, other government consolidation, it's up to the financial secretary how he wants to do it. But exchange fund going forward, I think the minimum principle is that has to be a surplus from an investment gain from last year that you think is comfortable, and partial of that investment gain, not you don't use up everything.
Right. So by the way, let me advertise a little bit, because we had an exclusive interview with John Greenwood. And then he was talking about, his comments on whether it's appropriate or not that Hong Kong government transfers such amount. Let me, I won't expand here, yeah, but I encourage you to subscribe to SMP or even read it on smp.com. It was exclusive story this morning. So, as Kenny mentioned, Northern Metropolis is a long-term investment. It can be 10, 20 years, in the coming. So how Hong Kong can maintain its near-term growth in the economy, because FS estimated that the GDP growth will be 3% on average in the coming 5 years. So how Hong Kong can get that growth in between? Do you have any ideas where the growth will come from?
Well, for this year, I forecast about 3.2% of GDP growth.
Within the range of 2.5 to 3.5%.
That's actually on the higher end of the range.
Higher end of the range.
Yeah, so I think that for the near 1 to 2 years term, we first have to take a step back. I do feel that the momentum in Hong Kong, the recovery has been broadening. And that recovery broadening has been confirming one sector at a time since middle of last year. Remember, we had a deep seat moment, equity rebounded, IPO came back, financial activities came back. Then in mid-year, we saw a flow in the property market, especially for the mass property homes. And then we also saw increase, higher retail sales, and in particular, if you look in the luxury retail, that's a combination of higher wealth effect from the equity, a bit more tourism, and plus gold price increase. I think the Middle East issue prolongs, some of these investment gains is going to continue to be positive. But then we also seen investment, I think from the perspective of the escalation of risk versus between China and US that we have gradually been confirming throughout 2025. I mean, we were super pessimistic at the beginning of the year. Then over the years, over all the negotiations, we got a little bit more confirmed that this will be a managed, although a bit fragile, truce, but then we are now moving onwards. On that China backdrop, Hong Kong is actually moving onwards. And I think from that perspective, recovery is taking hold, and we would extend that to a plus 3% potential growth for the coming years.
Right. I mean, last year, Hong Kong had a roller coaster on the economy. But what about this year? Because of the Iran situation is still going on, many people are still getting stuck there. So, and the trade-off will be affected. So what was your estimate?
My 3.2% of GDP, I have to confess that I didn't change this post the Middle East events. First of all, it's only over the weekend that we now being to factor in this could be a more prolonged conflict than original expectation of a 7-day event. Market has a general perception of this, but then as we go into more developments in the Middle East conflict, people have to have a longer risk scenario, especially with oil price now above 100. It's a bit more concerning. But I think coming out of every volatility that we had with oil price, we weathered through higher inflation a little bit. But then we can continue to work on our growth story, which I think the focus should still be back on the 12 5-year plan, Hong Kong's upcoming 5-year plan, and therefore some of these actually international unfortunate events may actually also be weaved into additional business opportunities from our side. I think risk diversification, it's on everyone's mind now that a quick thought to be 7 days event is now likely to be a longer one, and therefore some of the previous exposure in other regions needs to be rethinked. And I think that naturally would just benefit the Hong Kong financial market first before other things?
Okay, so when we talk about the revenue, so I think we can actually look back to the current revenue source this year. So actually, we found that all 5 key drivers, for example, like the stamp duty, land premium, investment income, salary tax, and profit tax, all 5 areas growth. But of course, for this year, we can see the stamp duty is very important. So, but as we all know, stamp duty and investment income are all highly fluctuated, so we are quite difficult to make sure the market perform well. But I don't think actually we can do nothing. For example, we can try to find some ways to expand our stock market activity and also to increase its daily turnover. For example, one of the recommendations is to extend our trading hour. In the past, Hong Kong, London, and New York complement each other to cover the global clock. But nowadays, the London Stock Exchange and also the New York Stock Exchange, they are exploring 24-hour trading. So for the Hong Kong Stock Exchange, I think we also need to think about whether we need to extend our trading hours so that to maintain our global competitiveness and also increase our transaction. And the second recommendation is also in the financial market, if we can consider to lower the stock connect threshold for the mainland individual investors. The stock connect has matured over the decades. And I think it's time for us to review and see whether we can lower the entry requirement for the mainland investor, because in the past, they need to have around 500,000 RMB to invest in the Hong Kong markets. So maybe we can try to lower it a little bit to, for example, like 250,000 RMB. So it can also attract more mainland capital. And the last one is that some stock in Hong Kong actually cost high money in one single lot. For example, some stocks even up to 100,000 Hong Kong dollars per lot. So it is difficult for the retail investor to buy. Even they can participate, they may just able to buy one lot. So they are difficult to sell, for example, like half of the lot to lock in their profits. So we should study whether we can lower the size per lot, for example, or even consider the one share, one lot like US. So all these things can also encourage the retail participations, and it can also increase the daily, average daily turnover in the stock market.
Well, I think a lot of points are being covered, so I intend to maybe answer more in the next questions. But if I want to supplement a couple of points, I think in terms of the revenue that the government will have to rely on, I think we should not expect very significant changes. So I think the sources mainly will be coming from profit tax, salary tax, stamp duties, and I think generally we see some optimism, right? I think a lot of research reports are showing optimism about the stock market, and it will be further fueled by it's a very strong pipeline of IPO coming to Hong Kong. Another thing is the housing market. We are seeing more and more of the evidence of a return of the market, and I think unlike stocks, which is more like a random shock in the near term, but then for property markets, momentum is very, very important. And we see also, I think some figure shows that 25% of the new properties bought recently purchased by people with a mainland Chinese spelling name. So I think, and anecdotally, we see a lot of mainlanders coming to Hong Kong. So I think these are all good indicators. And in terms of the effects of the tariffs, I think you know, a lot of people said that Trump is taco, right? And then I think it seems like the global economy has adapted to the effects of the tariffs. In terms of the ongoing war in Iran, some people would think, some people who are more pessimistic. We think that this will be just like the war in Ukraine. There can be no end to it until maybe there will be another tackle. So I think these are the few points I want to supplement.
Right.
Very comprehensive answers.
Thank you so much. You know, one thing I really want to touch on is about the yuan internationalization, because it's a national policy, and it's also Hong Kong can play a very critical role in that. And because of Hong Kong's financial state, global financial center status, and the infrastructure, the software, everything. So how Hong Kong can play a better role in this, especially on the backdrop that it has to facilitate mainland companies to go global.
I think I would start off with, the financial market, the diversification of currency of the bond issuances has already been pushing ahead RMB International where we could or allowed to do all these years. But then last year we have seen a proliferation of renminbi trade settlements and renminbi financing. Remember last year we had a 1.2 trillion trade surplus in China. That's again all these trade conflict backdrop. That trade settlement increase with China has also helped with the settlement. Then we also have seen financing of denominated in renminbi increase substantially because of the lower interest rates onshore. So I think that was already something that in recent year has been showing additional progress. But to go forward, I think the recent diversification of government issuance in Hong Kong in renminbi, it's popular in the backdrop of, like, say, US dollar debasement, as well as renminbi internationalization. I think having this additional choice is something that we can capture from the financial opportunity. But I think at the end of the day, this is actually something, as you say, that we are now trying to do finance plus. We wanted to enhance use our banking strength to enhance the INT development, as well as Chinese firms that are going to be moving offshore, investing offshore. And in that regard, Hong Kong has always been a favored hub for treasury corporate center. And then we also have been a very favored asset management hub. I think from that perspective, renminbi internationalization is indeed taking deeper roots and making mileage as we can see it.
So maybe I add one thing on the financial piece, because I think it is really important. So actually in the previous year, the Hong Kong government also want to attract more tech companies to list in Hong Kong. And of course, we have Charter 18A and also Charter 18C. And it is still quite success because around 100 firms are clearing this line for listing. But of course, we also have some ways to further improve because, for example, even the 18C modification in 2024, the market cap requirement is still quite high in Hong Kong if we compare with other leading stock exchange market. For example, in Hong Kong, we are talking about 8 billion Hong Kong dollars market cap for the pre-commercialization company, and also 4 billion Hong Kong dollars for commercial companies. But if you look into the US, the market cap requirement in NASDAQ is just talking about 0.6 billion Hong Kong dollar. If you look into the Shanghai Stock Exchange, this requirement is just talking about 1 billion RMB. But of course, if we try to lower the market cap requirement, we also need to make sure all these tech companies are in good standards. So at this way, I think actually the government can also add some alternative financial matrix. For example, like whether this company have the positive cash flow test and also the proven revenue streams. And for those tech company, in the pre-commercial stage, we can also add some R&D milestone stage. We can learn from the Chapter 18A. Actually, those P-profit biotech company, they can choose to list in Hong Kong once their core products finish the clinical, the phase 1 clinical trials. So for other technology companies, if they have recognized R&D result, or for example, like proven distinct technology advantage, so whether we can consider trying to qualify this company with a lower market cap requirement.
Professor?
I think in terms of offshore R&B, I think the acceptance, the demand for it, I think is evident. I think if there's some a bit more offshore R&B, I think that will help the role that Hong Kong can play as well.
Right, that's great. You know, I've seen some questions already. So before we open the floor for questions, can I ask each of our respected, panelists to summarize your view, your comment, on the budgets in one word? It's a difficult question, isn't it?
One word.
In one word. The quota is one word.
I would say improving. Yeah.
Improving. Okay. We should reflect it to FS later.
Appropriate.
Appropriate, okay.
Can it be 2 words?
Well, one word is a quota.
Prudent.
Prudent. So we have improving, appropriate, and prudent. Great. So, we have a few minutes. Let's take 2 questions. I've seen the first question is Hong Kong government bonds are lower quality and less liquid than Chinese government bonds in CNY, and naturally treasuries in the US dollar and Hong Kong dollar is still packed. So why focus on debt issuance? Anyone want to weigh in on that? It's a very broad questions.
Because I cannot tell, what's the guess alternative, right? So instead of issuing bond, what are the alternative? So it's just you have to think about a practical alternative that the government has, right? And let's be creative, right? We may securitize some future revenues that the government can collect. We have seen some other governments doing things like that. And one candidate may be the land premium, right? The land premium that we can collect is very, very low, but let's say the market is overall optimistic about the recovery of the economy, the property market, and the land premium will increase. And you want to have money to spend, then one way is to securitize that future stream of income. But I think that can be very difficult because it's a highly volatile revenue source, making it difficult for us to securitize. So maybe, I think it's really about, what are the other alternatives that the government has other than issuing bond?
I will focus on the first part of that question. When it was mentioned that Hong Kong government bonds are lower in quality and less liquid than Chinese government bonds in CNY and US dollar treasuries, I think at the end of the day, it is 1, market pricing, 2, it's matching of currency as well. The US dollar treasury versus Hong Kong dollar bonds is one thing, and where we are pegged. But on the other side, the renminbi is you typically would want to invest in CNY for a certain quota, depending on your bank's risk appetite or bank's holding of cash to match it. So I think having additional issuance in Hong Kong dollar, having that additional supply is also for the purpose of liquidity management of our Hong Kong banks as well. So I think that is an important factor that have already sustained previous government bond issuance, in Hong Kong exchange fund bills and notes. And now this is just recategorized into a new name and increase in supply, which could be used for our long-term capex.
Right. You know, one related question is, the government was saying it will extend the duration of the bonds, right? So how long is this bonds, and what do you think the government should really, look at the duration of the bonds?
I think it needs to first grow the duration by a bit at a time. Extending duration is you typically match it with regional peers, but at the end of the day, you also want to match it with your customers' appetite. As I mentioned, there's other companies who have needs for like maturity mismatch needs to purchase long-end bonds. We also need to build out the curve at the longer end, because with the hope of government being the benchmark bond, we can have an official yield curve that is longer, and therefore other commercial or even like supranational would be interested in tapping this end of the market. And once we get to that point, I think that is what you can consider as a deepening of market, and by itself would attract additional clientele to the bonds issued by Hong Kong.
I see.
May I just add one point?
Of course.
I read, so maybe I misread. I don't think government bond is of low quality, by the way.
I don't think so.
Hong Kong government bonds are not of low quality.
It's a sovereign rating.
It really depends on your bank's risk profiling, on what you need. Like usually it's even by that day, what you need in Hong Kong dollar, what you need in US dollar, what you need in CNH.
Sometimes I think because of this geopolitical situation, and then the US dollar was pretty strong recently. So how does it affect the bonds demand or the bond market development in Hong Kong? Is that a better time to issue more debts?
I think the planned issuance is to, depending on market window, they will issue almost 100 billion amount new ones throughout the year. I'm sure this will be done by tranches. Typically, during risk-off period, like intense geopolitical period, there's a lot of, there's higher scrutiny on what type of bonds can be issued. And Hong Kong government bonds being a high-grade one, I think will have lesser of a problem, but you actually is attracting clients from other types of lower-grade quality bond issuers. But also, I think at the end of the day, we're talking about issuing more bonds for the long term. And so short period of higher US, more expensive US dollar, or even lower interest rate that we expect in the Fed cycle for the remaining of the year ahead of US election, will not significantly deter the appetite of Hong Kong dollar bonds being issued throughout this year.
Right. I think we have the last question. So this is not the first time that the government transfer financial investments into asset investments. Can anyone comment on what were the outcomes and key learnings when it was done before? I think the last time was 1984.
Okay, maybe I can answer that part. So actually, the government did use the transfer for several different economic purposes. And of course, like in 1998, the government used around 118 billion Hong Kong dollars to support our stock market during the Asian financial crisis. And even in 2001, actually the government also used a small amount of the exchange fund to purchase the IFC office. So actually it is also, you can view it as an other investments. But of course, from this experience, it seems it is a successful case, and I do hope, again, this year is also a successful case. But we can also try to look at other economies, because I remember moderator asked whether other economies do the similar thing. So actually, in Singapore and also in Norway, they also will use the sovereign fund to transfer some money to support on different programs. But of course, they have some guidance. For example, like the Singapore, the government can use up to 50% of the investment income to support their public spending. But Singapore's case is a bit different to Hong Kong because they issue bonds, as I mentioned, they're mainly for their sovereign fund to invest. So of course, if they have earning in the sovereign fund, they can use it to support. But for the Norway, it is a bit different. Under their fiscal rules, actually, they can transfer 3% of their sovereign fund to support the deficits. But mainly, it is for their daily operations, daily expense. So I think in Hong Kong, in these aspects, we just use the transfer for the capital work, like the Northern Metropolis case. So I mean, in these areas, Hong Kong seems to have a stricter fiscal discipline. Yeah.
I see.
First of all, I think I think we already talked about this, that the transfer is, after all, is triggered by windfall of large investment return, and also as a percentage of the exchange fund is like 3 point something to 4%. It's really not significant. I think it's about the messaging. You know, personally, I'm not concerned, right? Number one. Second is about how to, and hopefully will help to send a message that this is for like strategic investment, and the government will make such a decision prudently, and then the government still have the large enough fund to defend the peg rate. I think that's the key. Yeah, I'm really not that worried about this small percentage of transfer.
And maybe just to extend that on a more constructive vibe, I actually want to point out that, again, Hong Kong is on a broadening outlook recovery. Yes, there's still a lot of issues that we need to deal with. There's some selected sectors that we still need to assist them to transit to AI, transit to new shopping culture, integration with the Greater Bay Area. But then overall, I have been very confirmed since middle of last year that the recovery is broadening across financial, property, even some of the luxury shopping, as well as into investments, as you can see in the fourth quarter GDP breakdown. So I think that should like be a positive story to like message to send when your budget, which I thought was appropriately fiscal prudent,
Right.
and yet pushing for growth.
That's great. You know, thank you so much for our guest speakers. And then we have the improving budget, appropriate budget, and prudent budget. So, so thank you so much for everyone. You know, and also your insight. Thank you.